Hello, everyone. Today on the final bar, my guest is Sean McLaughlin. Sean's the chief options strategist at StockCharts. We'll talk about the NASDAQ today. The NASDAQ weaker, while the Dow stronger and the S&P in the middle. How many days in the last couple of weeks, the last month, have we had that as the overall conclusion? I feel like a lot. Sort of the S&P in the middle. This is that choppy sideways digestion period on the S&P with a lot of doji candles, a lot of sideways movement. The Dow and the NASDAQ on the outside. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the message of the markets. We focus on the charts, which I would argue represent investor psychology, decision-making, behavior, fear, greed, anticipation, excitement, euphoria, desperation. All of those emotional drivers of stock prices arguably are reflected in the prices of the assets themselves. That is the logic. That is what I read from the book by John Murphy years ago as I was first introduced to technical analysis. Those are the things I keep in mind still to this day as I'm looking at hundreds, if not sadly thousands of charts on certain days to try to make sense of things for myself and clients and our viewers. And it still holds true, right? If you have one thing to try to make sense of a stock or a company or an ETF, I would argue the chart of the stock is where you want to start. Everything else comes after that. And we have a great guest today, Sean McLaughlin from StockCharts. He was on our Options 101 panel not too long ago, which was really, really fun. And I'm excited to hear his take on the NASDAQ today. Tomorrow on May 6th, on Thursday, we have Xenia Taubina from XT Financial Services. Xenia is more of a short-term trader focusing on Elliott Wave, and I've learned so much over the years talking with people who look at different time frames, different markets, different approaches than my own, and so I'm excited to hear how she's dealing with this consolidation phase in the markets. Coming up next week on Tuesday, the 11th, we have Jay Soloff. Jay is from, where is Jay from? Oh, from Investors Alley. He's the lead options analyst there. And then on Wednesday, the 12th, we have Bob Lang. Bob's the president at Explosive Options. Great guests coming up and again, each of them are bringing things that are top of mind for them. And it's one of my favorite parts of the show is just getting some different perspectives. Also, as a reminder, coming up next week, the next Money Show virtual event is happening. I will be speaking on Wednesday, May 12th at 1:30 p.m. Eastern. I'd encourage you to go check it out. There's go to moneyshow.com, or if you're watching this on our YouTube channel, we have a link below the video that you can sign up for that event. But it should be a lot of fun coming up next Wednesday. Let's continue on with our market recap. So overall, the S&P had a strong morning and a weak afternoon. You can see on the 2-day preview chart here, making a new swing high there and pushing to the upside the first half of the day, and then coming back and settling back to the lows. I tell you what did not feel like it settled down at all was energy, which just continued to go to the upside. We have a number of energy stocks reporting earnings this week, including ConocoPhillips yesterday. We have Marathon Oil after the close today. And if we look at the chart here and a little bit of ConocoPhillips, you'll see why sort of have a decent bounce. By the way, our segment a little later, we're going to do called The Bottom Line, where we focus on earnings. It's another heavy earnings week with a lot of companies reporting and a lot of potential catalysts for stocks going up and down. We're going to look at some of the companies that have reported the first half of the week. Let's see what sort of movement we had leading up to and coming out of those earnings releases. So the S&P essentially flat, mid caps and small caps, to be honest, they all were sort of around the zero level. In terms of the real relative movements, it was the Dow being a little bit higher, the NASDAQ being a little bit lower, but overall, relatively sideways day. The VIX is actually back down around 1925 or so. In terms of other asset classes, 10-year yields actually were higher earlier in the day, but ended up closing the day below where they're at. And the TLT was up just a bit. The dollar was flat for the day. Gold actually appreciated essentially through the course of the day, with the GLD finishing up around 0.4%. The commodities as a whole finishing stronger. And as I mentioned, energy stocks up pretty good. If you're looking for a big pile of green, cryptocurrencies are a pretty decent place to check out. Bitcoin is up about 7% today. Some of these others were up even more. And so forth. So overall, plenty of volatility in these assets. Still a lot of question marks for a lot of investors. But I tell you where there are very few question marks, in my opinion, are the uptrends that you're seeing. These are resilient charts, and even though there is plenty of volatility, you can see that overall, net, these are in strong uptrends, and certainly indicating signs on days like today that there's further upside potential to be had. Let's look at a daily chart of the S&P again. Today was sort of a flat day, and it's finishing after yesterday, which was a little more distribution, but you had a nice bounce. You closed about halfway through the range yesterday. Today, you opened a little higher, but settled back down to the previous close. So 2 days now in a row, and actually 3 of the last 4 where you've closed below the open. If you're looking for signs of raging optimism, I don't know if you'd see them there. And you're seeing after the run, you can see essentially a compressed volatility. But, for me, I was doing a webinar earlier today, and what strikes me on the chart of the S&P, as I was sharing with the audience there, I think the bearish divergence, that you see with the S&P with higher highs in price, lower peaks in momentum reminds me a lot about the bearish divergence that you had in January, where the new high was an overbought condition. The secondary high soon after, a couple of weeks later, was not in the overbought condition. At that point, it was about a 5% sell-off down to the 50-day moving average. I think at the least, that's something that's very reasonable to expect right here. I think that's I would characterize that as highly likely. Begin first things first. You need to break the most recent swing low, right? An uptrend is higher highs and higher lows. A downtrend is lower lows and lower highs. So until you make a lower low, the short-term uptrend is still in place. Breaking 4120, I think, would validate that bearish divergence. I think that gives you at the least a move down to around 4,000, which would be the 50-day moving average. Also a trend line taking the lows from October and March. If and when we break 4120, which I think is very likely in the short term, you'll hear me talking about 4,000 as being as a decent, minimum objective for a pullback. We hold that, and this again becomes one more move higher. And I think there's a scenario where that happens. You're looking at financial stocks, looking at energy, looking at industrials. There are plenty of charts that look pretty good. And even though some of the FANG stocks are distributing in the last week, overall, there are plenty of stocks doing just fine and in pretty good uptrend. So I think there is plenty of momentum in certain pockets that could certainly lift the market higher from here. Just could be certain stocks that are working and certain ones that other. If you break the S&P 4,000 level, I think then you have to really think about further downside risk. Think about what happens to your portfolio if the S&P gets down to 3,700, gets down to 3,200. And I'm not saying that is a likely scenario, but it's a scenario. And I've often found, waiting for the S&P to get to 37 to think about what you would do in that scenario is sort of an underwhelming way to plan for a potential future path. I like thinking about what the market would look like, what stocks may work or what not, what I would need to see on charts that I'm holding to start to make me a little less confident in their uptrends. And now is a good time to start to think of it. When we start breaking 4120, if and when we would break 4,000, which makes it look a little more painful than the pullbacks that we saw in January and then in early March, I think that's when you start thinking about some further downside potential. But at this point, I would say high risk of a 5% pullback. I think that would be, even if you're bullish, I would argue that's one of the better things you can see, because that gets us out of wait and see mode and more in pullback mode when some of these longer term charts that have been stronger start to maybe look a little more attractive after a bit of a pullback. Continuing on here in terms of sector rotation and sector leadership, the 3 top sectors, and then it was sort of everything else. Energy, number 1, up over 3%. Materials, number 2, up 1.3%. Financials, number 3, up 0.8%. These are sort of the cyclical sectors that we've been talking about. We've been looking at some of the charts of Freeport-McMoRan in the material sector, things like WAL in financials and others that have bounced nicely. In energy, we're going to look at some a little later when we talk about earnings. What did not work today were the really defensive sectors, actually. So this is not about defense or offense over defense or anything like that. It was more of a rotation into sort of the value space, but not in the really defensive sectors of utilities and real estate. Real estate have been arguably some of the better relative performers here in a while. And the sector, up until the last couple of days, has been one of the better sectors out there, but giving back some of the recent gains. After that was sort of the FANG sectors: consumer discretionary, technology, and communication services. And again, not down a ton, but down just a little bit there. In terms of groups, particular groups that work, what strikes me looking at the industry list is 4 of the top 10 are in energy, coil, oil equipment and services, integrated oils. That's the big integrateds like Exxon, Chevron, and others, and E&P exploration and production all up pretty good, which makes sense. 4 of the top 10 are in materials, things like aluminum stocks, steel stocks, commodity chemicals. And these are, stocks and groups that I find a lot of people don't pay a lot of attention to. Materials are actually a pretty low weight in the S&P, so it's easy to sort of ignore them and their investment possibilities. I would certainly encourage you to check those sorts of groups out if you have not. What underperformed today, again, it's a lot of utilities, a lot of real estate. Other than that, sort of the travel groups, right? Travel and tourism and hotels out of the consumer discretionary group, drug retailers, medical supplies, also some of the most hit overall today. So you can see some of the groups up pretty big, some of the groups down pretty big as well. It was sort of a bifurcated market of sorts in terms of what was working and what was not. Finally, before we take a break, I just want to point out some of the less impressive charts when I'm looking at my global ETF list are in Asia, Japan, China, the FXI, the MCHI, and those are some of the worst performers today. Top performing ETF, Brazil, with the commodity orientation that sort of makes sense. We need to take a quick commercial break. We'll be back with my guest, Sean McLaughlin. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com. It's great to have you join us every weekday after the close for our show. As a reminder, we do a mailbag segment twice a week. We'll do another one on Friday's show. We would love to hear from you. Any questions that come up as you are analyzing your own charts, as you're trading your portfolio, as you're trying to think about asset allocation, as you're reading and watching things elsewhere, any questions that come up that we can help you with, let us know. The Final Bar at StockCharts.com is our email. We're on Twitter at FinalBarSCTV. And on our YouTube channel, just put a comment below the video that you're watching. We'll capture all of those and hope to answer your question in our next mailbag segment. Also, as a reminder, the new StockCharts TV on demand is out. It is free and it is available for you whenever you're ready. Go to StockChartsTV.com. Use your email. You can set up a free account there, or we're also on all the app stores. Just search for StockCharts TV on demand. I want to welcome on my guest joining us once again, Sean McLaughlin. Sean's the Chief Options Strategist at All Star Charts, coming to us from Colorado. And Sean, it's been such a pleasure to get to know you over the years, get to know you and your work. You always bring some charts that make me think, and welcome back to the show.
Hey, David, thanks for having me. I enjoy this. This is a lot of fun.
So, a lot of people thinking about this rotation or really the lack of confirmation, right? The S&P going higher, the NASDAQ, depending on how you're measuring it, not really participating in the most recent gains in April. Start us with the Qs. What's your perspective on what we've been seeing?
So what we're looking at in the Qs here kind of echoes what you were talking about when you were describing the setups and the technical action in the SPX. We're starting to see some divergences. We're starting to see relative strength decline. And as you can see in the chart here, if you zoom out on weekly charts, we're kind of bumping up against a Fibonacci extension off of let's call it the coronavirus lows of last March. And now look, for those of you who follow me on social media, I'm Chicago Sean. You've probably grown tired of seeing me tweet, "It's a bull market," because I've been tweeting it for feels like 10 years now. And while I'm still generally bullish, we're looking at these QQQs and we're thinking, well, if it's going to pause or if it's going to pull back, this feels like the right place to do it. And the research team at All Star Charts thinks that if the QQQ does roll here, we're certainly not calling for a crash or anything dramatic, but we think the 275, 274 level could be something that we could hit in, give it 2 or 3 months. We don't think it'll happen all in 1 week, although we've seen that happen before, right, David? But we think that over the next few months, if it runs out of steam, 275 in the QQQs looks like a reasonable and, let's be honest, long-term healthy pullback for the Qs. And so if you want to flip to the next chart, I'm an options guy. So I want to talk about a trade that I put on today to express this bearish bet. Now, this is not an aggressively bearish bet because I'm not ready to just start getting bearish here, David. I mean, we've been in a bull market for too long. We've had too many fake outs as everybody knows.
Sure.
So I'm certainly not going to load the boat on the short side, but the trade that I put on with options and is what's called a put ratio spread. Now, I forgive me on my chart. I put June at the top. I actually did this trade in July options. That's a typo on my part. I apologize. But the trade that I put on, basically with the Qs at the time we're trading just above 330, I basically shorted the 330 puts in July and purchased 2 times as many 300 puts. And what this effectively does, David, is if we're completely wrong, if this is just another pause that refreshes and just another fake out that gets everybody thinking the market's about to sell off, and we either grind further sideways or even scream higher from here, the nice thing about this trade is I was able to put this on for a credit. And if the market goes higher, if QQQ goes higher from here, worst case scenario, I keep the credit. I collected 285 for this spread. All right. I'm not in it to make 285, but I'll happily take it. Not bad getting paid when you're wrong, right? But on the flip side, if the market does sell off, if the NASDAQ does sell off, this position will benefit in 2 ways. Obviously, it'll benefit from the directional bias of the trade, but you could bet. I hate what's the phrase I'm looking for? You could definitely bet on volatility rising if we start seeing any significant sell-off in the markets. And volatility rising will benefit this position. So we'll get the directional bias kick and the volatility kick working our way. And my plan is, if everything plays out according to plan, which it rarely does, David, but if it does, and we get down to that 275 level, that's our price target, that's where I'll look to take the trade off and book a profit. I think it'll be a pretty meaningful profit. And this is the way I'm trading. I'm not getting aggressively bearish here, but I do want to be positioned just in case. And hey, I can get paid if I'm wrong.
I love that idea. And that's not an insignificant pullback. And we go down to the levels that you're talking about. It's about a 15 to 20% back of the envelope sort of pullback in the NASDAQ. And I think you're right. I mean, it arguably, I think it could be in the long term. We zoom out enough, it actually could be a reasonable pullback within a longer term uptrend. Interesting take. And I appreciate you talking through an option strategy that makes sense for it, Sean. Sean McLaughlin, listen, thanks so much for joining us. As always, appreciate you bringing some charts to nudge our thinking. Stay safe, be well. Talk to you again soon.
All right, David, looking forward to seeing you in person again soon.
That would be awesome, wouldn't it? Soon. That's Sean McLaughlin. Sean's the chief options strategist at StockCharts. He's based in Colorado. And it's interesting, I really like talking with people like Sean who are looking at different charts, thinking about different things. I don't use a lot of Fibonacci projections, and I asked occasionally about that. Earlier in my career, I did. I worked so much for trend followers that were so uninterested when we would hit a target. They wouldn't want to do anything. They said, if the chart's still going up, I still want to own it. So I got away from that, but I love talking with people like Sean that are noticing this. And I might be wrong, but I'm pretty sure if you look at the chart of the S&P, I think we're about 161.8% above the range. If you look at sort of the February to March sell-off from 2020, I think if you run the same analytics on the S&P, I think we're also at sort of a Fibonacci projection. I might talk to some of my peers in the industry that are more objective oriented and see if that's true. But very, very interesting. And you can look Sean up at Chicago Sean on Twitter. Let's continue on. Our next segment is called The Bottom Line. We introduced this segment recently, thinking about earnings and all the companies that are reporting, heavy earnings week last week, heavy earnings week again this week. And to be honest with you, earnings are always happening. It's just certain periods, obviously much busier than others. And we're in this stretch where we're getting a lot of data from a lot of companies updating on top line and bottom line data. And as you can see from a lot of the movement that we've seen in the equity space recently, they have certainly are potential catalysts for movement. So focusing on stocks that are reporting, focusing on how the charts are performing leading up to the announcement, coming out of the announcement, can be very, very interesting. Today, we're going to start looking at the energy sector. As I mentioned, the energy sector up pretty good. Yesterday, before the open, you had ConocoPhillips, COP, report earnings, and a number of energy companies out as well. We've got MRO actually reporting after the close today. But you know what's interesting on the chart of ConocoPhillips, which honestly looks a lot like a chart of the XLE or a lot of energy stocks. You obviously had a really good run. If you end the clock, if you stop the clock there at the end of October of last year, and I remember looking at these charts at that time. I mean, it was hard to think of a group that looked worse than energy stocks as they're making new swing lows. They're just in this consistent pattern, kept hitting the 50-day moving average from below and failing. And I remember thinking, like, there's absolutely nothing on this chart that would make me want to own a stock like this. And then look at how that changed. In the month of November, it was a complete 180, literally. And if you start the clock on November 1st, you see a relatively consistent uptrend, especially through the peak in March. So you've seen, the huge rally out of the lows from energy. Financials really started to work. Some consolidations, but overall, look how the lows kept getting higher. Now in March and April, this is after a lot of sectors, a lot of groups. The S&P itself started to show bearish divergences. This is where you saw a little more rotation. This is where the growth trades started to work a little bit. Interest rates coming off, and you saw, energy stocks pulling back to varying degrees, right? And ConocoPhillips and many energy stocks actually broke their 50-day moving average. Others like FANG come to mind, actually still holding it, didn't really fail there, but overall, certainly in pullback mode. Now that has changed once again. And now you've seen a new swing high, you've seen a higher low, and now the gap higher today for COP, I think, puts it back into bullish mode. We've taken the stock above that swing high from late March. I think this is rotated back to the upside. And overall, this is happening as the RSI is getting above 60. So what's interesting is, as this chart has been in an uptrend, pretty classic bull market behavior from the RSI. And what that means is, in upswings, you want to become overbought. When you pull back, you want the RSI to remain above 40 usually, and that indicates overall a stronger trend. The whole range of the RSI goes up. Compare that to what you saw here in mid-2020, where in upswings, the RSI doesn't get above 60, and in downswings, it can become oversold. So we've gone from bearish phase there in mid-2020 here to mid-2021, where you're more in a bullish phase. So I like the pullback that you saw in those energy stocks, and I like the rotation higher. FANG is another one that reported last week, if I remember right. No, Monday after the close. I remember just jotting that down not too long ago. That was Monday after the close. Had pulled back a little bit yesterday, a bounce higher today, about 5%. But overall, these stocks have held RSI 40. Some of them have held their 50-day moving average. Those that have not are starting to rotate higher. And I think looking at that group opportunistically could be a really good thing. Pfizer had sort of a whipped around day. They reported yesterday morning on Tuesday, and last 2 days have been a nice move higher. However, you can see today was a volatile, but in the end, not much of a directional day. Sort of settled in right at yesterday. So now you've had 2 days of sort of the doji candle, where the open and close are right about at the same level. Overall, the chart of Pfizer, isn't bad. It's actually a decent chart. It's holding up pretty well. You're starting to, reapproach those highs from last December. The problem I have with something like Pfizer up until the last month or two has been the relative performance. This made a new relative low in February, and at that point, when it's undercutting its 200-day and making a new, multi-year relative low, that's not much to get excited about. But you can see, if you start in March, it's actually been outperforming the S&P and a nice run higher. Again, it sort of turned, made a bottom there at the beginning of March. And from there on has actually been a nice sort of uptrend. So I think tracking that uptrend, taking a trend line off of the lows isn't bad. You've had a nice bounce so far off of earnings, hasn't really followed through yet, but overall still holding up okay. There's nothing on that chart that would cause me to to be super concerned about things. Jumping around at some of the other stocks, I'm going around the list of things that have reported either recently or today. Hilton actually came out earlier today. You can see the stock's down just over 4%. It concerns me a little bit. A stock like this, you've seen the divergences, seen the lower momentum as the stock has been going higher in the last month or so, lower and lower RSI. You see the relative strength has turned over. It's making a new 2-month relative low, we'll say today, but breaking back below its 50-day moving average. A number of times along this uptrend, you've seen pullbacks that have undercut the 50-day, and it resumes that uptrend. So overall, it's similar to previous pullbacks. Again, I would be looking at when that pattern breaks. If you remain below the 50-day moving average, you can continue to see distribution. I'd much rather be in stocks that are showing accumulation and less distribution. GM was actually earlier today as well. That was one of the pre-open names. And overall, it looks a bit like some of the energy stocks in terms of the recent action. Looks a lot like FANG. Nice uptrend, a pullback to an ascending 50-day moving average. It's chopped around there a couple times. RSI has held 40 many times over the last year. And overall, it could be the beginning of a hook a little bit higher. We need to finish. Man, the show goes by so quickly when I'm trying to look at individual charts. PayPal is where we might have to stop it. Now, this is actually reported right after the close, and I have not looked at it yet. So let's see what's happening. And as a reminder, if you're looking at stocks after the close, you want to see what happens around earnings, bring up the symbol summary page. That's where we show our after hours data. Hopefully, over time, we'll be adding this to other parts of our platform, but that's a quick way you can see what's happening. So PayPal is actually down just over 1% today. After hours, actually bouncing up around 3.6% so far after the close. And so this was actually making a new swing low, getting below its 50-day moving average. It's going to pop it up just a little bit. So right now it's trading around I just missed it. Hold on. Trading up to 256. So that's it's not too great. It's sort of back up to the 50-day moving average. So, the concern I have with the chart at PayPal is it's sort of in consolidation mode. It looks like based on the bounce you're getting after the close, we're still right around a flat 50-day moving average. This looks like a lot of other charts that are sort of consolidating, right? It's not going down dramatically. It's just no longer going up. And now for sure is the last chart I'm going to show. I keep coming back to the ARK Innovation Fund. I see that in a similar pattern, sort of this consolidation, testing the lower end of that, trading below its 200-day moving average today. I'll be very interested to see if we get downside follow through after the RSI peaking just below 60. I think we will. And I think this signals a little further rotation down in the growth trade, potentially in line with what my friend McLaughlin was sharing earlier today. We need to wrap this show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is looking at Bitcoin, but it's also looking at Bitcoin versus the GBTC. The reason why I'm bringing this up, cryptocurrency is super hot. As you can see today, up double digits in a lot of cases. Bitcoin has had a pretty decent run here, up 40-some% year to date. So why is the GBTC, which is supposed to be tracking Bitcoin, essentially flat, up a handful, right? Single digits when Bitcoin is up so much more. And it has to do with the fact that it is a trust and it trades at a premium or a discount to the holdings of it, right? So GBTC and things like it kind of hold a bunch of Bitcoin, and then essentially it's not driven purely on the price of Bitcoin. If you look at the movements of the chart, it's similar movements. However, the gap between performance is significant, and that's something you need to be wary of when you look at any ETF. GBTC is trading at a double-digit discount to its underlying value. ConocoPhillips is chart number 2, nice bounce in energy, and I like the rotation back to an upswing, higher highs and higher lows is an uptrend, and that's what we're starting to see once again there. Final chart we'll have in the 3 and 3 is AT&T. I almost did a deep dive in communication services today, but switched it to focus on some of the earnings names. But if I had, we were going to talk a little bit about this group, the fixed line telecom group. This is AT&T, Verizon, and some others. AT&T, if you take the unadjusted data, so do _T on StockCharts, you can see we're just threatening and arguably getting above the December 2020 high. This could be just a huge multi-month, if not multi-year base rotating back to the upside on a stock that yields about 6.5% on the dividend. So it's a decent dividend pair that's held up very well, starting to show signs of strength yet again. Folks, that's our show for today. Thanks so much for joining us every weekday after the close for the final bar. A special thank you to McLaughlin from All Star Charts, joining us from Colorado, sharing his thoughts on the NASDAQ. For StockCharts.com, in Redmond, Washington. I'm Dave Keller. Be safe, be well. Talk to you again tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.